Uh, Hello and welcome uh, to the today's session. My name is Yasser. I am your tutor for today's learning outcome three. Be able to prepare financial statement for a group of entities. Uh, Before I start, can you see my screen and can you hear my voice if anyone is there? Okay, so let's get started. Self-assessment on a scale of 1 to 10, rate your current knowledge of financial statement and consolidated financial statement. Uh, Indicative content, be able to prepare financial statement for a group of entities, statement of cash flows, structure and preparation of group accountants, associate and joint arrangements, changes in group structure, change in group structure and foreign transactions and entities. So prepare group accounts including statement of cash flows. The International Accounting Standard 7 outlines the requirement for preparation of statements of cash flows, which summarize the movement of cash and out of a business during a specific accounting period. This statement provide important information to use of financial statements regarding an entity's ability to generate cash and cash equivalents. Cash is defined as cash on hand and demand deposits, including current accounts, petty cash, and bank overdrafts. Cash equivalents, on the other hand, are a short-term, high liquid investment. There are readily convertible to known amount of cash and carry uh, an insignificant uh, insignificant risk of changes in value. So, such as deposit accounts and investments maturing within 3 months. Any question? All right. So, requirement of International Accounting Standard 7. Uh, Requirements of International Accounting Standards cash flows are categorized into three main categories. Okay. So, activities, basically operational activities, uh, investing activities, and financing activities. Operational activities covers the principal revenue producing activities of the entities and other activities that are not investing or financing activities. Investing activities involves the acquisition and deposit of long-term assets, other investments, and classified as cash equivalents. Finally, if you look at financing activities, these activities include activities that result in changes in the size and composition of contributed equity, share capital, and borrowing of the entity. So, International Accounting Standard or IAS 7 allows for two methods of presenting cash flows from operating activities, the indirect method and direct methods. The indirect methods reconciles profit before tax to net cash from operating activities, while the direct method lists and total actual cash flow. So most entities use the indirect method for its simplicity and alignment within other financial statement. Any questions so far? Anyone is there? Okay, so requirement of uh, IS 7. So for the indirect method for of a cash of format of the cash statement of format of the statement of cash flows indirect method. For the indirect method, the format of the statement of cash flows includes a reconciliation of profit from operations to net cash from operating activities. These conciliations involves adjusting profit before tax for items such as finance cost, depreciation, dividend received, gains or losses on disposal of assets, and changes in inventories and receivables payables. The resulting figures represents cash generated by operations after accounting for various adjustments, including interest and tax payments. When we talk about direct methods, of the other hand, presents cash received from customers and cash payments to suppliers and employees directly. So, followed by adjustments for interests and tax payments to arrive and at net cash from operating activities. Both methods aim to provide users with a clear understanding of an entity's cash flows and its ability to generate cash from its core operations. The statement of cash flows for limited companies, if you look at here, a detailed breakdown of cash movement categorized into, uh, you know, operating, investment, and financing activities. Uh, yeah, investment activities, financing activities, and investing activities and financing activities. So net cash from operating activities represent the cash generated or used in the company's core operations. Investment activities involves the uh, you know purchasing and disposal of property, and then uh, uh, disposal of property, plant, and equipment, so as well as interest and dividends. So received. So financing activities includes proceeds from issuing share capital, uh, increases in bank loan and dividends paid. So the net increase or decrease in cash and cash equivalents is calculated by uh, considering the beginning and ending balancing of cash and cash equivalents. Preparing the financial statement of financial statement. So, preparing the financial the statement of cash flows To prepare the statement of cash flows, several steps are followed. Cash generated from operational operations starts with profit before tax and adjusts for finance cost, typically equivalent to interest paid, uh, uh, depreciation, dividend received, including in investing activities, and gains or losses or assets deposits. Changes in inventories, trade receivables and payables are also factored in. So interest and tax payments are calculated based on accrual of opening and closing balances. Investment activities involves determining the purchase and disposal of property, plant, and equipment, as well as proceed from disposal and dividends received. Financing activities primarily involves changes in share capital, loans, and dividend payments. So, cash and cash equivalents involves net increases, decreases, should equivalent. So net increase and decrease should equal difference between closing and opening figures in statement of financial position. Any questions so far, if anyone is there? So usefulness of the statement of cash flows, advantages, limitations. The statement of cash flow offers several advantages, including the ability to alert users to identify issues, demonstrate how efficiently profits and converted to cash, and provide a factual representation of cash positions unaffected by accounting policies. It can add in predicting future cash flows, and is often easier to understand than profit statements. Standardized heading enable comparison between different entities. However, limitations, if you look at limitations, include the potential for multi-pollution of cash balances and the risk of focusing uh, solely on cash flow at the expense of long-term profitability. Additionally, historical cash flow data may not always accurately predict future cash flows. Any questions so far, if anyone is there? Questions from almost born handbook. These questions likely relate to the concepts covered in the previous discussion regarding the preparation and interpretation of the statement of cash flows. So prepare group accounts incorporating associates and uh, joint arrangement. Any comments on this, if anyone is there? Okay, prepare group accounts incorporating associates and joint arrangements in financial reporting. Uh, a group of companies comprises a parent company and its subsidiaries, which each company within the group of legally distinct. They operate collectively as a single economic entity known as the group. The international financial reporting standard or IFRS provide key definitions to understand group accounting. A parent entity is one that control one or more subsidiaries, while a subsidiary is controlled by another entity. So the parent consolidated financial statement uh, present the combined financial position of the parent and its subsidiaries, and as if they were a single entity. Uh, Control within a group is important and defined by three elements: uh, power, exposure to variables, returns, and the ability to affect those returns. An investor controls an investee when it possesses the power to direct its relevant activities. Relevant activities has exposure to a variable return and can use its power to influence those returns. So typically control is evidenced by ownership of more than a 50% of the voting power unless stated otherwise. So power is usually extended through ownership of equity shares, primarily through voting rights. Any questions so far, if anyone is there? The consolidated statement of financial positions. Uh, the consolidated statement of financial position process of preparing consolidated financial statement involves several steps. First, the group structure is established, indicating the relationship between the parent and its subsidiaries. Then the non-controlling interest of the time of acquisition is calculated, representing the portion of subsidiary ownership not held by the parent. Goodwill, an intangible asset representing the future benefits from acquired asset, is then determined. This is followed by calculating the consolidated retained earnings reserve, so which considers the retained earnings of subsidiaries post acquisition. Finally, co-controlling interest at the year end is computed, reflecting the equity in the subsidiary not attribute to the parent. Hi, Hinesh, how are you? Okay.
Hi, yes, yes. Sorry, I'm late.
No, that's fine, no problem. Uh, have you got any message from UK University? There wasn't any session last week. I didn't know by the last Saturday, so I've been told that third session will be today.
Okay,
That's
okay.
why.
All right.
So this is a third session, and then fourth session, learning outcome four will be tomorrow, and then assignment session will be next Saturday. So okay. So are you okay?
Uh, I'll be fine. I'll be just staying calm and being careful.
Oh, okay, okay. Today we are discussing as financial statement of financial. If I go here, you know, that today we are talking about financial statement. S- preparing financial statement for groups of entities. So, Uh, then consolidated statement of financial positions, step 4. Just continuing from the previous, step 1, 2, 3. And then here for the consolidated retained earning reserve is calculated, taking into account the retained earnings of both the parent and subsidiaries. So this process exclude the pre-acquisition profit of subsidiaries from the consolidated retained earnings reserves. No controlling interest at the year and it's determined, so representing the portion of the subsidies of subsidies net assets not owned by the parent. The calculation ensures an accurate representation of the subsidiaries equity in the consolidated financial statement. So these steps provide a systematic approach to preparing consolidated financial statements, ensuring a compliance with international accounting standard and accurately reflecting the financial position of the entire group. Any question? Can you see screen and everything? Okay.
Yes.
Okay. So in the preparation of the consolidated statement of financial position, assets and liabilities of both parent companies and its subsidiary of, uh, here, if you look at, so S Limited, parents company P and its subsidiaries S Limited are combined. So this includes 100% of the subsidiaries, individual assets and liabilities. Uh, so assets and 100% of the subsidiaries, individual assets and liabilities, even though the parent only owns 80% of it. So the equity section of the statement reflects the share capitals and retained earnings of the parent companies, along with the non-controlling interest in the net assets of the subsidiary. So the deletes the portion of equity attributes to the parent and the uh, portion attributable to monetary shareholders. So consolidated statement of profit and loss, basic consolidated consolidation step by step. Yeah. So to prepare the consolidated statement of financial profit or loss, the financial result of both the parent and the subsidiary are aggregated. So this includes uh, revenue, cost of sales, operating expenses, finance cost, and tax. So intra-group sales and purchases are adjusted to eliminate any double counting and uh, you know. And unrealized profit on intra-group transactions are added to the cost sale. So the resulting profit of the year is then allocated between the equity holders of the parent and the non-controlling interest in proportion of their ownership percentages. Uh, the if you look at here, the consolidated statement of profit loss present the combined financial performance of the group of the year. It include revenue from both the parent and subsidiary, adjusted for intra-group transactions, operating expenses, finance cost, and taxes are also consolidated. So the profit for the period is attributed to the equity holders of the parent company and the non-controlling interest in accordance with her with their ownership interests. So any impairment losses on goodwill, any impairment losses on goodwill are typically recorded as administrative expenses. So intragroup sales and purchases are addressed by canceling them against each other to avoid double counting. Any unrealized profit or these transactions are added to the cost of sales, which reduces closing inventories. A non-controlling interest is calculated based on the subsidiary's profit of for the year and its share of unrealized profit. So this ensures an accurate representations of the group's financial performance and the equitable distribution of profit between the parent and minority shareholders. Further points, uh, consolidated financial statement must include all subsidiaries of the parent. Uh, Basically, must including all subsidiaries of the parent company. This ensures a comprehensive view of the group's financial positions and performance. Additionally, these statements must adhere to uniform accounting policies for similar transactions and revenue in similar circumstances. So, if a subsidiaries employ different accounting policies from the parent, uh, uh, adjustments must be made before consolidation to maintain consistency and comparability across the group. So any questions so far? uh,
Um, so adjustments would be based on, say, the way they treat the accounting for example, depreciation or the accounting of assets.
wh- you are talking about profit of loss.
So the slide, the last slide was looking at adjustments. So looking at the policies, accounting policies. So the
Which
accounting policies would be uh, how the subsidiary would have a different method of
Oh, okay,
valuing.
okay. Oh, yeah, understanding. You are talking about here that is a question that if subsidiaries had a different, methods,
Yeah,
so and control. So yeah, basically, legally, if parent company and subsidiaries are considered a single economic, different accounting policies from the parent. Okay, they can
yeah.
do that. So adjustment must be made before consolidation to maintain consistency and comparability across the groups. So before consolidation, they can do their adjustments.
Mm.
Okay. Prepare group account that involves changes in group structures. So basically, when one company acquires more than 50% of ordinary shares of another company, uh, it's typically gain control over the second company. Uh, have you got any comments, Hinesh?
Yeah. So in very simply, my understanding is ordinary shares. It's not any other shares,
Yes, it
preferential
says
shares.
it mentions that if the ordinary shares.
Okay, so
Yeah,
those are very important.
yeah, that's a very important. That's why it's mentions that ordinary shares. Okay, not any others. So yeah, you're right. Anyway, it's a very important that uh, ordinary shares of another company. So it typically gains control over the second company. So this control allows the parent company to appoint, all the directors of the subsidiaries and effectively manage its operations. So while legally distinct, the parent and a subsidiary are considered single economic unit or a group. So in terms of their economic substance, international accounting, if you look at here, yeah, here. So International Accounting Standards 27 provides definition for subsidiary and control. So outlining the circumstances under which consolidated financial statements are a requirement. So consolidated financial statements should be prepared when the parent company has control over the subsidiary. Control is usually established based on ownership of more than 50% of voting power, but other forms of control are possible. When we talk about in consolidated income statement, the consolidated income statement summarizes the profit generated by all resources disclosed in the related consolidated statement of financial position, representing the net assets of both the parent company and its subsidiary. It follows basic principles, including the inclusion of all income and expenses from both entities subject to adjustments. After determining the profit for the year, the statement splits it between the amount attributable to the parent shareholders and the non-controlling interest. So, reflecting ownership, uh, 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 non-controlling interest reflecting ownership property. So the mechanics of consolidations involves standard working such as determining the group structure, calculating goodwill, and allocating the non-controlling interests share of profit. There are different links, various changes in group of, you can visit knowledge bank, that this is a Kaplan, I think so, knowledge bank link, and from I think so, this one is a ACCA chapter 18, and a statement, the consolidated statement of financial position, ACCA chapter 18, and then chapter 19, you can visit for further information. Again, any questions so far, Anesh?
Uh, Not at the moment.
Okay, can you see screen and everything is good?
It's clear.
Okay. So analyze the accounting requirements that relate to foreign transactions and entities. Any comments or anything you want to say about?
So when you say foreign transactions, these are physical.
We are
Uh,
talking about globally, that
yeah.
international transactions. So
So you're dealing with so the company that you're producing the financial statements for, any transactions, any trades
yes,
they do with other companies outside of their
yes,
location. Okay.
yes. Any foreign relate to foreign transaction, and yeah, any. You're right. So here, basically, if you look at here, due to the increasingly global nature of investment and business operations, there has been a move towards the internationalization of financial reporting. So, with the increasing globalization of investment and business operations, there's been a push towards the internationalization of financial reporting. This harmonization aim to provide consistent and comparable information to a global audience. So when companies employ different accounting methods, okay, it becomes challenging to make informed decisions across different entities. So, standardizing accounting concepts and principles is important for meaningful comparison. Thus, before making any assessments of comparison, it's necessary to ensure that the accounts are prepared using the same accounting standard to facilitate relevant analysis and decision making. So that's why that we they always talk about IAS, International Accounting Standards. Uh, Here, basically, when we talk about also, have you heard about IFRS, International Financial Reporting System? If you look at here, he's talking about different countries that were adopted for all listed entities in 2005. So they use same, a method. So have you heard about the International Financial Reporting Systems?
Standards,
Yeah,
yes.
standards. This is basically, you know, uh, uh, it not inherently enforced in any country. They are formulated by an international organizations without international authority. So to become enforceable, they must be adopted by a country's national financial reporting standard setter. So within the European Union. So IFRS was adopted for all listed entities in 2005. Several other countries, including Argentina, Australia, Brazil, Canada, Russia, Mexico, Saudi Arabia, and South Africa, have also adopted IFRS. So countries like the US and China, India are in process of convergence, aligning their national standards with IFRS over time to ensure consistency. So, for further information or further reading, you can visit Chapter 1, Introduction to Accounting, Kaplan Knowledge Bank as well. I'll just try to open this one. Can you see this on my screen, Hanesh?
Um,
No.
I can't see
Yeah,
the
basically,
link.
I think so. I can't share this. So, basically, this is introduction to accounting, define accounting, explain. Accounting consists of two elements: recording, summarizing, and financial statement. So basically, it looks quite good. So you can, visit this chapter as well.
And it's free to access.
Yes,
This,
it is free to access. It is completely free to access.
okay,
Yeah. You just can you see that? Uh, this website. So you just click on this, so it is free to access.
okay,
So you can visit this. Yeah. Also, you have some learning material on your Moodle as well. I believe so. There is as well. You
okay. I'll
might,
check that
yeah,
after.
you might have some books over there.
Okay, all right. I'll let you know
So,
if
so otherwise, just tell me tomorrow. I can share some, accounting or financial books as well.
okay. Thank you.
No. Uh, then evaluate the need to prepare detailed financial statement when changes in group structures occurs. So, when preparing consolidated financial statement, it is essential to carefully assess and consolidate the assets and liabilities of both the parent and subsidiary entities. For example, in the consolidated statement of financial position, balance on intragroup, current accounts should be eliminated to accurately reflect only external assets and liabilities. Uh, Also, fair value adjustments on the subsidiary net assets at the acquisitions date must be recognized, and the parent's investments in the subsidiary should be replaced with the goodwill arising from consolidations. So these adjustments ensures that the consolidated financial statements provide a true and fair view of the group's financial position as if it were a single economic entities. Fair values adjustments in consolidated financial statements. The concept of fair value holds significant importance. According to International Financial Reporting Systems 3, when a parent company acquires identifiable assets and liabilities from a subsidiary, these should be recognized in the consolidated financial statements at their fair values as of the acquisition date. So, but when exactly is fair value? What exactly fair value is? Uh, any idea about fair value, Hinesh? Any comments on this?
Um, Fair value will be determined by the explanation from the standards.
Uh,
So examples will be provided for how an asset can be,
and liability as well.
yes, and liability can
Yeah,
be
yeah.
valued. And this is crucial because this is where creative accounting can be abused.
Yeah, so basically fair value, yeah, the spot on, you're right. So fair value basically represent the price that would be received to sell an asset or paid to transfer a liability in an ordinary transactions between market participants at the measurement date. In simpler term, it's the amount that would be exchanged in a transaction between willing and knowledgeable parties. So when calculating goodwill, which is an essential component in the consolidation process, it is based on the fair value of the identifiable net assets of the subsidiary at the acquisition date. Consequently, before consolidations, adjustment may need to be made to the assets to reflect their fair value accurately. Moreover, there might be a need to recognize additional assets or liabilities, such as the subsidiaries internally generated intangible or contingent liabilities, which could impact the overall uh, um, financial position of the consolidated entity. So occasionally, a situation may arise where the acquisition result in a bargain purchase, meaning that the fair value of the identifiable net assets acquired exceeds the considerations paid. So this results in what is known as negative goodwill. So while rare, if such a scenario occurs, the gain on the bargain purchase is recognized immediately as gain in profit or loss. So again, this is very rare. Again, useful link for further reading. Chapter 3, Fundamental Exam Study Resources. Uh, you can visit this for further knowledge. Uh, Let me check. Yeah, it explains about how to prepare a consolidated statement of financial position. Statements are often referred to as a group accounts. Yeah. So you can visit your learning management system for further reading. Otherwise, uh, if you need any further books for accounting or you need any other material, just let me know. So I'll share some books and
Okay.
websites tomorrow. So that's it for today. Uh, any questions so far, Hinesh?
Yeah. Sorry, I missed earlier on. So,
Yeah,
yeah.
you will get a recorded anyway. You don't worry about that. You will get a recorded lecture as well, so you can see that. And if there is any question, you can drop me an email at yasir@ukversity.co.uk, or you can, that if any concerns, issues, you can discuss tomorrow as well. Okay.
Okay. Oh,
Okay. Thanks, Hanesh. Thank you very much for joining me today. So have a good weekend, and I'll see you tomorrow at 10 o'clock.
10. Okay. Thank you.
Okay. Thank you. Thank you very much, Hanesh. Thank you, and bye for now.
Bye for now.